Deloitte Tax, welcome to the Tax News and Views podcast. In this podcast series, we talk to specialists from Deloitte about the latest business issues and developments. I'm Curie Falkenhayn, your host for Tax News and Views. And for today's topic, we'll be digging into investment management organizations and specifically some of the multi-state tax issues impacting that industry. Joining me today are three Deloitte Multistate Specialists, Sean David, Amanda Sterling, and Derek Stringfield. Welcome everyone to the podcast. Sean, I'll start with you. And one of the major components of the investment management lifecycle is when they sell an investment or have a realization event. How do states factor into those transactions, and why is that important now?
Sure. Thanks, Carrie. So, generally the focus is on the federal component of transactions, and often the state side is ignored. The thought process is just that gains would be recognized in the investor's state of domicile, not too much thought is really given to it. But in reality, there's a multitude of state issues that can come up and should be considered. There's things like state sourcing and gain analysis, holdback calculations, structuring considerations, and even the interplay with some of the newest and hottest topics in state partnership taxation, like pass-through entity taxes and some other items that my colleagues will speak about today. And it's especially timely to talk about these state implications because we have funds that are winding down, but in the current economic environment where we may see an uptick in purchases of distressed assets, getting out in front to properly structure those transactions in a way that will mitigate the state impact upon realization is just incredibly important.
So you mentioned that there are complications from a state perspective that arise in these transactions. Could you give us some detail and some examples of how involving multi-state professionals in a realization event can make an impact?
Absolutely. Yeah, there's a number of different areas. And so a couple of them, I'd start with state sourcing and gain analysis, as I mentioned before. So for state purposes, the type of the transaction can be incredibly important. And there's little nuances in the way that the deals are structured that they may not really be thinking about from a federal point of view. So for example, if the transaction is a sale of assets versus a sale of a partnership interest, can have a drastically different outcome in regards to the number of states that gain may need to be sourced to and dragged through. And so there's also important analyses that can be done regarding the structure itself and whether the entities that are impacted by the realization are considered to be unitary or non-unitary with each other, which again can dictate how the gain is sourced. And so that analysis of unitary and non-unitary relationships is just incredibly important. And once you go through all of those types of analyses, there's the holdback calculations themselves. And so when you're looking at those, again, there's a lot of federal on the focus side, and there may not be any taxes that need to be held back from distributions. But on the state side, there's a number of them. There's the non-resident withholding, there's composite returns, and again, the buzzword, the pass-through entity taxes, all of which, may need to be held back in a distribution to partners. And in a worst case scenario, if they were missed, this could result in the need to claw back cash. So these state withholding issues are important to everybody, but they can be even more important in the investment management context with the number of institutional investors and tax-exempt partners that there are in these structures and how non-resident withholding could affect them. So realizing the structure and whether or not there's things like unrelated business taxable income being sourced to the states are all going to come into play in the analysis of this realization. And then really, at the end of the day, even with all the best planning, the landscape in the state world is constantly changing and evolving with new rules and regulations that could impact the way that the realization is sourced and it has and the state impact of that realization. There are recent court cases that completely changed the way that we may have handled something in the past. For example, in Massachusetts, there was a technical release just released recently that really changes the way that you source the gain on the sale of a partnership interest in Massachusetts that essentially flips it on its head. And so in situations where you may have been forced to source gain just a year ago, you may not have to do that anymore. So it's really important to understand what's going on in the current landscape. And so the interaction with those types of things and some of the, again, more buzzworthy state partnership taxation areas like pass-through entity taxes all need to be considered. There's states that tax PETs on the full distributive share versus states that tax on an apportioned share need to be considered together to figure out if it makes sense to be elected into in different states. But also at the same time, doing a full analysis of that to determine if it's a situation where maybe the cash outlay is too much for the partnership, and the benefit isn't as necessarily as high as they may have originally thought. So really, ultimately, what it comes down to is the ability to model out these transactions, to really go through and identify all of the benefits and any potential pitfalls that may exist as well.
Well, there certainly sounds like there are a number of traps for the unwary that could have some real cash consequences if they're not properly thought through. So thank you for that, Sean. Amanda, maybe I'll turn to you now. As we heard from Sean, the investment management and investment advisory space certainly has no shortage of hot topics when it comes to multi-state taxation. Tell us a little bit about maybe what some of the most exciting or necessary conversations you're having with asset managers and advisors these days.
Thanks, Carrie. You are absolutely right. We have seen exponential growth in these markets. In parallel, the evolving complexity of state and local income and indirect taxing regimes create a wide range of both risks and opportunities. Our overall goal is to proactively address the companies and partners' cash flows and reduce risk. The state tax positions taken by a fund can be questioned by external investors, financial statement auditors, and tax authorities. Nexus is consistently a big item of discussion for investment managers. Wayfair has broadened their interpretation for Nexus and demonstrated that Nexus can be created in a state and/or local jurisdiction without any physical presence. Market-based sourcing rules for investment managers and investment management services, coupled with economic nexus principles, can rapidly increase an investment manager's state footprint. COVID-19 has broadened work-from-home policies, resulting in a workforce that potentially spans way beyond the investment manager's traditional office locations. Nexus may be created as a result of employees working from home, which can result in unintended increases to an investment manager's state tax footprint, income tax, and payroll tax compliance. And of course, hand in hand with doing Nexus analysis is a sourcing analysis. Revenue streams must be dissected to analyze how state sourcing laws apply to each specific revenue stream. As state and local tax jurisdictions shift to market-based sourcing, many jurisdictions lack a clear interpretation of market-based sourcing for investment management services. Various jurisdictions require management fees to be sourced based on the location of the ultimate investor, like where I sit in California, while others may look to the location of where the fund is principally managed. Many jurisdictions require different sourcing methodologies depending on the customer's tax status, like if they're a regulated investment company. And they can differ depending on the investment manager's tax status along with its partners, like having to look at the partnership and corporate rule sets. A big topic of conversation is also pass-through entity taxes. As a result of the TCJA of 2017, individuals are limited to a deduction of $10,000 for state and local taxes. Over half the states now and New York City have enacted pass-through entity tax regimes, which can have a material impact on investment managers in pass-through form, like partnerships or S corporations with individual partners. We have been focused on helping investment managers understand their applicability to state pass-through entity taxes, modeling the potential benefits and detriments of such regimes, as well as navigate the complex federal and state implications of pass-through entity taxes.
Well, there's a lot there and a lot of changes when you factor in how Wayfair is being interpreted and the implications there on nexus and sourcing, and pass-through entity taxes is clearly can be very impactful in this space. But I also heard you mention local taxes. Why do those matter to investment managers and advisors?
You're right, Carrie. Local taxes, as well as gross receipts taxes, can have a significant impact on investment managers. And coupled with the work from home protocols and implementing policy to continue to allow employees to remain remote, we've seen potential opportunity to reduce entity level taxes associated with some of the local taxes imposed. New York City imposes a tax on pass-through entities conducting business in the city. There are a multitude of highly audited issues that should be analyzed for risk purposes specific to investment managers, like payments to partners, broker-dealer sourcing, apportionment, the list goes on. New York City also has a commercial rent tax. San Francisco city taxes are another one worth mentioning that impact investment managers with employees and activity in San Francisco. San Francisco imposes a gross receipts tax, and worth noting, if an entity were to have established nexus in San Francisco but does not have employees in that entity, the city would look to the partners for purposes of sourcing for the gross receipts tax. San Francisco also has a commercial rent tax and an overpaid executives tax. Even where I sit in Los Angeles, there's LABT, or Los Angeles City Business Tax. And the city has a tax imposed on gross receipts when employees are working within the city. Now, not a local tax, but a gross receipts tax we often see missed is the Washington Business and Occupation Tax, or B&O tax, as we refer to it, impacting investment managers with receipts from Washington-based customers in excess of $100,000. Many investment managers are managing money and have more than $100,000 of Washington receipts from funds with Washington investors, foundations, state pension funds, or individuals located in Washington. The Washington B&O is a gross receipts tax, and going back, Washington has had economic nexus and market-based sourcing regulations all the way back to 2010.
Well, that's really interesting to think about how work from home policies could be impacting these local taxes. Thank you for sharing that. I'm going to move now to Derek. And over the last few years, we've seen more and more references to private credit in the news. So what makes funds that focus on private credit unique? And why should we focus on the state tax issues for those funds?
Thank you, Carrie. Yes, private credit is one of the fastest growing asset classes in the investment management industry. And we're seeing a number of our clients who have not historically been active in the private credit space launching these private credit funds. And these funds have some unique complexities that you don't normally see, or that our investment management clients do not normally see with other types of funds. Generally, when you're talking about state source income in an investment fund perspective, that fund is receiving a K1 from an underlying investment. That K1 is going to determine what states it files in and the income that it's going to source to a particular state. From a private credit fund perspective, that meets the definition of a trade or business. They are treated more like an operating entity, and they must figure out which jurisdictions they should file in and calculate the state source income that they should report to those jurisdictions at their level.
So it sounds like it's a completely different set of state tax rules that apply to these private credit funds. What are some of the complexity that investment managers should be aware of?
Yeah, so there are a number of unique complexities to private credit funds. One of the first things that we have to look at when we're dealing with these funds is, one, whether the income is business income or is it investment income. So first, we have to determine if the fund is in a trade or business of loan origination, or is it only acquiring or investing in debt securities that have already been originated by a third party. If it is determined that the fund is in a trade or business of loan origination, then the income would have to be sourced at the fund level. If it's determined that the fund is only acquiring or investing in debt securities originated by a third party, then it may not have to source income at the fund level. Many states have special rules for qualified investment partnerships sourcing the income to the individual partner state of residence. If the fund invests in debt securities, then it may meet that definition of a qualified investment partnership. So we determined if the fund meets the definition of an investment partnership in the respective state in order to qualify for the state's special rule for investment partnerships. And like a lot of things in state tax, the rules surrounding investment partnerships vary among the states. So we have to make sure that we're performing the test using the correct or the specific state's rules. In several states, investment partnership is generally defined as a partnership with 90% of its assets and 90% of its income from qualified investment securities. However, the definition of qualified investment securities can vary by state as well. For example, purchase loans and loan participations may qualify as qualified investment securities in certain states, but not other states. And then if the fund meets the definition of an investment partnership, then as mentioned, it wouldn't have to source the income at the fund level. The income would be picked up at the partner's resident state. However, if the fund doesn't pass the investment partnership test, then we have to look at nexus and sourcing rules.
So you talked about the investment partnership test. How does nexus then factor into that?
So when we're looking at nexus from the investment partnership test, if you meet the definition of an investment partnership, then the partnership wouldn't have nexus in any particular state. If you fail the investment partnership test, then we have to do the nexus analysis to determine which state the partnership has nexus in. We would look at things such as physical presence, factor-based nexus, economic nexus, and taking into consideration like judicial and administrative decisions that may apply, including the U.S. Supreme Court's decision in Wayfair. And then we'd have to review each particular state's rules to determine if there are any special considerations for loan origination. We'd have to understand the location of the fund deal team members, consider whether deal team members work at office locations or work remotely, as that can impact the fund's nexus footprint from a physical presence perspective.
Okay. And then again, if the fund does not meet the definition of an investment partnership, what does that mean from a sourcing of revenue, apportionment, et cetera, perspective as well?
And so if a fund does not meet the definition of an investment partnership, then once we've determined which states the fund has nexus in, then we have to look at each of those states' sourcing rules. And this is where it can get even more complicated, since there are a number of states that have financial organization rules. Generally, those rules are in the corporate statutes, but there are a number of states that apply those to partnerships as well. If a partnership meets the financial organization rules, for example, California requires a financial organization to use a three-factor formula versus the regular single sales formula and include certain intangible property in the property factor. So you can have a pretty different answer if you're a financial organization. Instead of using a single sales factor in California, you have a three-factor formula and you're including the loans, asset value in the property factor. And then also we have to look at it from a market-based sourcing perspective. There's a number of states that have special rules around loan origination. If it's a secured loan, oftentimes under the market-based sourcing rules, you're going to source it to the location of the property if it's secured. If it's an unsecured loan, then you're going to source the receipts to the location of the borrower. The analysis in identifying whether or not the partnership has a filing obligation, if it does have a filing obligation in the state, whether or not it has nexus, and then also the sourcing rules, the apportionment rules, and whether or not it's a financial organization can be pretty complex, and it's not something that a lot of our investment managers are used to dealing with.
Well, I guess it's no surprise that private credit funds have a number of state tax issues as we see across the investment management industry. So thank you. Thanks all of you, Sean, Amanda, and Derek, for sharing that information and reinforcing the complexity of state taxes as they apply to investment management organizations. If people would like more information, you can go to Deloitte.com and search on State Tax Matters. That is a regular newsletter that updates on state tax developments. So you can subscribe for that. There's also an archive for tax alerts on Deloitte.com that you can visit. And if you want to search pass-through entity tax, there's a number of articles that you can find that can give you more details around that. Feel free to connect with Sean, Amanda, or Derek also on LinkedIn. And in the meantime, thank you all for listening. We appreciate you joining in, and I hope you continue to be well and tune in for our next episode. Take care, everyone.